Hello, my name is Emmanuel Jurczenko. I'm the Director of Graduate Studies and Professor at Finance at Glion Institute of Higher Education. Welcome back. Welcome to Leading Hospitality Through Turbulent Times. This session will be a presentation of about 30 minutes with 50 minutes for question at the end. We are taking, as usual, question in writing only. You can use the chat box to submit them. And just as a reminder, the session is being recorded and will be available on Moodle platform afterwards. So now I would like to introduce our special guest today. So I'm very happy to welcome Cyrille Urfer. So Cyrille is the head of Sovereign Wealth Fund at Unigestion, which is a Swiss asset manager based in Geneva. Cyrille got more than 30 years of experience as chief investment officer in various institutions, both private banks in Switzerland and also sovereign wealth funds. So very, very happy to have you today. Cyrille, the floor is yours. I think you will talk about what is going on in the markets after this COVID-19 crash. Where are we going? Cyrille, the floor is yours.
Thank you. Good morning to everyone. I hope that you will be able to also send questions and make it as lively and interactive as possible. I'm sure for the ones that have followed the news over the last couple of months, you've seen that economies and markets have suffered quite extensively from the coronavirus outbreak. And we will review what's the sequence, the stages of that crisis, and then their impact on asset classes, investment vehicles, and so forth. And then we'll try to give you some of the maybe the future and what could happen onwards. It's an important element. I think it's a unique time for most of us. It's a unique crisis. And the impact will be not only severe, but certainly prolonged as well. Just quoting the US Deputy Secretary General, the crisis will hit economies around the world quite heavily. And it's probably one of the most important and severe financial crisis and economic crisis we're going through. We also, in the press, we see many different quotes and reference to the shape of the potential recovery after the correction we had. Here I'm quoting President Trump saying that clearly by looking at the evolution, the behavior of the US market, yes, we had a severe correction from basically mid-February up to the 23rd of March, and the recovery, at least from an equity market, has been quite strong, as the market recovered by almost 45% from the trough, and therefore he's saying that for him really the recovery looks like a V-shaped recovery. Then the sequence, the stages we had, or the impacts and the sequence of impacts on equity markets on the current slides. It's a 4-act drama that really started in the first couple of weeks of January with a very favorable environment. Where growth was moderate but stable and improving to some extent. Tension between the US and China started to abate with the agreement on the phase 1 of the trade deal, and it helped the equity market, and especially the S&P in the US, to reach their all-time high. In a couple of days, then we had a sequence of events that will definitely put a lot of pressure on asset classes, on prices and economies. The first major one was the decision of Saudi Arabia to enter a price war with OPEC and in particular Russia. And on that day, the oil prices went down by more than 35% to reach a 4-year low. That's a major event that really, in addition to the pandemic, really impacted the market and the sentiment of many market participants. On March 11, the WHO declared that the disease was a pandemic, and it led to the phase 3, where market really sold off quite substantially and heavily. On March 12, the market was down 9.5%, the worst day since 1987, which was the crash at the time. Then helped the Federal Reserve, the U.S. Central Bank intervene and cut rates to near zero, which only happened in early 2009 during the financial crisis. And then subsequently on March 16, the market registered its third worst daily drop since the early 1900, and registered the third worst day with a drop of almost 10%. We reached the market lows on March 23rd, where clearly the market was considered to be in a bear market mode, and from March 23rd. We really had a pretty strong recovery, as we've seen on the previous slide, with the market up 45% as of June 5th. For the ones that looked at the press, we had a pretty rough day yesterday, which certainly I don't want to jump to the conclusion, but clearly we will continue to have fairly volatile markets and behavior going forward. I think we are far from the end of external shocks and volatility. How these different sequence of events impacted the different asset classes, and here you find the 4 different phases, and you see the performance of several asset classes. From the top, the top row is the government bond indices, and as you can see across the different phases, that market is considered to be a safe haven by many investors. Of the year. And then as we move down the different rows and lines, we go to from credit to emerging markets, and then on the fixed income side, and you see that these markets have also suffered, especially in phase 2 and 3. And the last 3 rows are equity markets, the red one being the developed world. And you see that, of course, the impact has been magnified compared to fixed income instruments, with -15 and -16% over phase 1 and phase 3, and a very strong recovery on phase 4. Interestingly enough, emerging markets have, during the sell-off, have been quite resilient, and particularly, and we will see later on, China has been quite a surprisingly strong and resilient in that phase, even though the epidemic started in China. And obviously, the last line is the energy that I mentioned earlier, and you can see that even in phase 1, the market was already under pressure before the Saudis started the price war. And we had two subsequent sharp sell-off, with also one of the unique situation where we traded even some of the energy future below zero during the crisis, due to the enormous supply and also the lack of storage capability. On that slide, we're using some of the indicators we've built at Unigestion to follow, monitor what is happening on a daily basis on 3 dimensions. 2 of them being macro dimension, recession risk and inflation risk, and 1 that is more market related, that really monitor what the market is telling us in terms of stress that is currently in the system.
And Cyrille, if I may, so those indicators are used, in fact, to determine your views and to determine the kind of composition of your portfolios, right? Because the different asset classes are supposed to have different behavior depending if you are in recession, inflation, and stress. So perhaps if you can make the link at one point between, sure, in fact, in terms of behavior of what is expected for the different asset classes.
Sure, I think it's a very important point. Just to have a bit of history on the NOWCASTER, it was initially created and is used by central banks for a fundamentally different purpose than the reason why we build them. As Emmanuel mentioned, we use this indicator, which is an aggregation of real-time data. We are aggregating about 1,300 underlying series to gauge where the recession risk is, inflation, and to have a good understanding of what is the market dynamic in terms of market stress. And what is very important is the linkage between these signals or this risk grade or risk score and how they are used to take asset allocation decisions. And as you can imagine, when recession risk is low, namely early in the year up to almost the 20th of March, it's an environment where we tend to favor what we call growth assets. That would include equity and credit, and up to some extent a bit of commodity. Inflation, as you can see, has not been an issue over the entire period, and has not been an issue for quite some time, I would say. And therefore, you find really at the first part of December and February a very constructive environment for risky assets, namely equity and credit. The one, and it's the reason why I highlighted it with the blue box, is the speed of change of the market stress. It's the most reactive indicator, and you see that from February 24th, where the market stress was very low, we moved in the space of 2 or 3 days to a situation where the market stress was very high. And the consequence of that change is, of course, we started to reposition the portfolio, reduce the exposure to credit in particular and equity and commodities, and move back to more defensive asset classes like government bonds or investment grade credit. And we will see also later on how quickly the risk grade or risk scores have evolved with the current situation prior to the sell-off of yesterday. But as I said, many of the macro elements tend to be slower to adjust, slower to react. But the market stress is really the one that drove the dynamism in our allocation. And here I'm just looking at the various components of the market stress NOWCASTER. We have 300 underlying families of indicator covering different part of the market that generally are good guides for to evaluate the amount of stress that is currently in the system. The first one is the liquidity, is how liquidity is available to the economy, and it's mainly monitoring also the way central banks and banks use the money, and how is it available to the different market participants. Volatility is a measure of risk that everybody knows, and measure how risky or volatile the market is. And finally, the spreads assess the price of different level of borrowers, and as you move down the quality spectrum, you expect to be paid for the risk you're taking, and the spread measure the willingness to investors to lend money, and at which price they want to lend it. Measuring by the spreads, you understand that if risk are higher, you would demand a much higher compensation for the risk as an investor that you are taking. If I go through each of these measures and also relate to what happened in 2008 and 9, as you can see, liquidity was increased quite rapidly at around the 20th of February. It's an immediate shock where market participants start to question if liquidity will be available, if money will be available for them. And in particular, here we measure also the liquidity within the financial system. And you see that thanks to the intervention of central banks, clearly the liquidity risk or the compensation required by investors or market participants for the liquidity really went back to a kind of normal level, or pre-COVID crisis level relatively quickly. As you can see on April, we were back to the level we saw in early 2019 and late 2019.
Just Cyrille, so for understanding how to read those graphs, on the y-axis, what you got is a spread, right? So it's
since the financial, and as you can see, yes.
Yeah, sorry. So just to help understanding the graph, so what you got on the y-axis correspond to the spread, meaning the risk premium or the yield which are asked, right?
Yes, correct.
So the larger, the more stressed the system is.
Exactly. It's a way to measure how market participants wants to be compensated for the risk of liquidity. And as you pointed out rightly, the higher the indicator or the spread is, it should be interpreted as there is more risk in the system, and liquidity is getting more and more expensive, which tend to be an issue for the ones that are borrowing money. And on the right hand side, a more longer term perspective, as you can see clearly, this time the ABS CP, which is the light blue line, is clearly not the issue. The ABS is the asset-backed securities, including mortgages, and clearly the current crisis is fundamentally different than the one we had in 2008 and 9, where asset-backed securities are not the issue this time. And you see also that the financial is clearly the banking system in the current situation is definitely not at risk of becoming insolvent, which also is an important element to consider in the current crisis, and to reflect to what happened in 2008 and 9. And the main reason why spreads on the liquidity side have came back to a more, I would say, normal level is the major and huge intervention of central banks providing liquidity in the system. You see on the left hand side the increase of the balance sheet of the Fed in late 2007 up to basically 2010, 2011, that really, it's all the programs that the central banks, here it's only the Fed, but it's the same in the in Europe and in Japan. It's all the different programs that central banks have put in place to support the market, in particular swap line, commercial paper, buying different type of bonds, and so forth, to support and provide liquidity in the system.
So just meaning liquidity, it means that basically, so there is what you call the commercial paper that correspond to the short-term spectrum. So
yes,
corporation that need money
yes,
for 1 month, 3 months, and going to the market.
correct.
So if the spread increases, just to say that if you need the money, you need to pay a higher level of interest rate, right? It's like if you go to the bank say, I will lend you money only at a higher interest rate. So
yes.
Problematic for the corporation. If it's too high, they cannot have the funding.
Yeah, especially
and
if they rely on short-term
spectrum.
financing. Yeah, especially when they rely on short-term funding. Correct.
And what is really striking is what the Fed is doing, right? Is now they are accepting, they are buying not even top quality bonds from corporation, but they even are ready to buy junk bonds. That mean debt which is issued by companies that get a high level of bankruptcy. So it just shows that the Fed is in the whatever it takes mood, right?
Correct. They want to make sure that the liquidity will be provided, that companies, and not only companies, but municipalities, the government, including government agencies and others, are able to refinance themselves relatively easily. It's also a very important element because leverage in the system since the financial crisis has increased substantially, which means that there is a lot of debt at every level. And of course, when the price of that debt increase substantially, you start to create some negative feedback loop in the system as the cost of money is higher. It becomes much more difficult for municipalities, governments, corporations to finance their activity, and therefore you increase the risk of having some of them going bankrupt.
Okay, thank you.
Sell-off or market crisis tend to come with higher volatility, which is an expression of the risk sentiment by market participants, but it's also a way to measure how expensive is to cover and hedge some risk that market participants have in their portfolios or in their activity. And here, as you can see, the volatility increased substantially from being very, very low for quite some time up to the end of February, where volatility spiked quite dramatically to a level that was almost 4 times the level we saw at the end of 2019. You also see that now we're more in a kind of normalizing phase where volatility came down, and therefore it's also an indication that some of the market participants are considering that they can price some of the consequences of the current crisis and therefore become a bit more relaxed or more thoughtful about the ability for them to weather some of the risk and the potential impact of the crisis on their position. And the last one, which touch upon the spreads, which is the cost of borrowing for different level of quality of corporates. And as you can see, we've seen a pickup, a substantial pickup that most of us have not seen in their career, moving from a very mild, fantastic environment for corporates with a relatively small spread or tight spreads up to the end of February, and then to an increase of the price of debt for this corporation up to 900 basis points of spread, which means that for low quality corporate, if they have to refinance, the cost of debt will be about, approximately 10%, rather than 3% in early February, which means that many of these companies that have a huge amount of debts and debt that are maturing will face much more expensive refinancing activity, which will have an impact also on their ability to generate profit and continue to operate going forward.
Cyrille, just if you
Yes.
go back to the previous slide, so IJ correspond to what we call investment grade. So
investment grade,
first,
yes, it's
so
the highest
first,
quality.
it's the best quality corporation, right,
Yes.
in terms of credit.
Yes.
And IL correspond to less quality in terms of credit, right?
Lower quality, correct.
What NA means here?
What? NA for North America.
Okay, okay.
That's
Thank you.
US.
Thank you.
There is, I mean, as you can see, the spreads between the US and Europe are fairly similar for the same quality of names. It's always interesting. There is small differences because the industry composition of these indices are different. And therefore you might have some discrepancy between the two, but I think what you see here is that the direction and the magnitude are very similar in the US and in Europe for different quality of borrowers.
So when you have something that was spiking at 900 basis points, it means that you have to pay 9% more, if I'm right?
Yes, correct.
The top of what you pay for a safe bond.
Yes, correct. The spread is always expressed versus the treasury, and we saw that mainly with the impact of central banks. Government bond rates have moved lower during the crisis, which the basis will be different. But on top of this government rate level, then you have to add the spread depending on the quality of the borrowers. Which means that if you were able to refinance yourself at 300 basis points on February 20, you were then able to refinance the same debt at 900, basically on March 23rd.
Yeah,
which
so
means
higher cost.
The many companies at risk. And you see here that now we're slightly more normalized situation, even though we've not reached the lows, but we're certainly in a much more, rational level or situation in terms of pricing the risk of some of the borrowers. Again, this is on aggregate, and if you go underneath the composition of these indices, you will have fundamentally different pictures. If you take the high yield in particular, a lot of the oil-related companies are almost in a kind of distress situation, where most of them will certainly not be around very, very long, as their business model and activity have been entirely affected by the COVID, but also the COVID will have an impact on demand for oil. But at the same time, they've been hit by a supply shock when the Saudi decided to flood the market with their production, which means that many of them are certainly in a kind of distress situation. And we've already seen in the US some bankruptcy. Probably one of the most famous is Hertz, the company that is lending and leasing cars, filed for bankruptcy in the US, which demonstrate that some of these businesses have been clearly impacted tremendously by the current crisis. You see the same picture here. We move to the equity market. You have on the left-hand side what we call the developed world, where some markets have been a bit more resilient than other. The Swiss market in green due to the composition of the market with a heavy weight in sectors like the pharma and the food, has been slightly more resilient than some other markets like the UK or Italy that have been impacted quite heavily by the crisis. On the right-hand side, we look at the emerging market world, and you see in red that China has done well during the crisis. If the market was at the worst, was down 10% year to date, which is much better than most of the other emerging market countries, as well as the developed world, which shows that even if the crisis or the pandemic started in China, I think the measure that China took really helped to weather the crisis, or at least the health crisis, in quite an effective way, and that has not had a major impact on the behavior of the equity market. It's also important to mention, of course, that some of the names that are listed and heavyweight in China have been main beneficiaries of the crisis, if I may say it that way, with the Tencent, the Alibaba of this world. All the e-commerce companies have, of course, not been impacted in the same way than maybe energy stocks or other activity like the hospitality. And therefore, it's also important to look at the composition of these different indices. And clearly the US, and especially the technology names, most of them have not. Yes, they went down in the first part of the sell-off, but many of them have recovered and even are in positive territory yet to date. I'll skip that one. What analysts, or I commented very quickly, and what analysts have, financial analysts have done, it's very similar to what we experienced during the financial crisis. Most of them have moved their expectation for 2020 to 2021. And you see that phenomena. Yes, earnings have been revised down to the similar level that what we had and we experienced in 2009. But you saw also on the right-hand side that the earnings expectation or estimate for next year have almost risen in the same magnitude, which means that it's more a question of having them hit in 2020 and facing no recovery in 2021, which is probably one of the reasons why the market recovered, is because now people, and financial analysts in particular, can put some numbers on what could be the impact of the current crisis on the different companies. Where are we now? Here it's quite interesting to see that even though we've seen a lot of still a lot of headlines almost on a daily basis, you see that and of course the impact of all these different lockdowns and restriction on the economic activity. We are currently seeing some level of improvement, and in particular the market stress is now from our indicator is back to a more normal level, and therefore it's a much more constructive environment in which we will be able to invest. You also see here the time lag, as I alluded to at the beginning of the presentation. The risk of recession clearly is fully now embedded in the numbers and expectation, and therefore you should not be surprised that yes, the hit will be big, but it's also most of it is already factored in. And as markets generally tend to price the future and not the past, the market seems to believe that there is potential from a low base, yes, but that the economy will start to recover, normalize, and then recover.
So just
Yes.
Cyrille, but I'm seeing the time. We are a bit run of time, but still the NOWCASTER. So
Yes.
those are indicators where basically the objective is not to forecast, right? Is to
Correct.
nowcast. That means to gauge where we are today, right?
Yes,
This
correct.
is the point. And as
Yes.
you mentioned, so the idea is to aggregate a bunch of different statistics.
Mm-hmm.
What is the frequency you reshuffle, you update those indicators?
These indicators are calculated daily.
Okay, so each day you have kind of vision about where we are.
Yes, exactly.
With respect to growth, inflation, and the market.
Yes, that's the purpose of the indicator, is to assess where we are now. It's not a forecast, as you pointed out, but it's just to understand where are we in the current environment. And it's the reason why we're using daily information or daily indicators or series of data, because some of the economic or macro dimensions tend to be produced and published with a lag. And even and in addition, most of the time these publication and numbers are revised for an extended period of time, which means that if you just if you consider only these lagging indicators, you will not have a good understanding of what has happened and what is happening. And that's the reason why we've built indicators that allow us to estimate what are the current risks from a growth standpoint, from an inflation standpoint, and a market stress standpoint.
Thank you.
Here the slides you're seeing is just to put the current crisis in perspective to crisis we experienced. I mean, from 2001, 8, and so forth, and you see that the recovery has been strong, has been rapid and quicker than the one we experienced in 2001 and 2008, but not dissimilar to the crisis we went through in 2011, 15, 18, which means that, yeah, the market has recovered quite nicely, but it's not an unusual recovery. Here you see an illustration of the point I made. You see that March 23rd was the low for most markets, and here you have we've constructed a newscaster, which is different than a NOWCASTER. The newscaster look at the information available in and headlines that are published to assess the sentiment available at a specific time.
Cyrille, sorry, you are frozen. Can you just repeat how is it constructed?
Yeah, the idea is to look at the news, at the sentiment. It's a way to assess the sentiment. Are people information, publication, newspaper are talking about the economic activity in negative or more constructive terms, and it's give us, of course, an indication that that is much more reliable for shorter term decision compared to the lag that we can see on the different economic indicators. And you see that these index tend to react much quicker than the impact on the economic activity. And it's a very important information for us because, interestingly enough, March 23rd was the lows, and it was also the lows from a newscaster, which was the most pessimistic situation for many market participants, expressing their negative views and the uncertainty that was created by the current crisis. And therefore, when generally what you have to do is you have to sell before things are getting worse. And when everybody is negative, it's generally a good indication that maybe we've reached the tipping point, and it's exactly what happened on March 23rd. Another dimension that is important is the valuation. Again, how expensive are different asset classes, and as you can imagine, with the sell-off, some of what we call the growth assets, or the growth type of asset classes like equity and credit became quite attractive. And as you can see, you see different points that shows the valuation level of these different risk premium or asset classes at different point in time. And you see that at the end of May, all these asset classes are becoming more attractive, or have become more attractive. And for some of them, of course, they are a bit less attractive at the end of April, as the recovery make them less cheap than previously.
So basically, credit and equities are cheap.
Yes, from that angle, yes. We think that after the sell-off, many of these growth type of asset classes became very cheap, and therefore certainly constitute quite an interesting entry point for long-term investors, as valuation tend to correct, but they tend to correct over time. And generally, when you buy an asset cheap, you certainly are in a better position to generate positive return going forward.
Yeah, because to make money on markets, you need to buy low and sell high, right?
Exactly. What is interesting to note is that that inflation or real assets are quite expensive from our standpoint. What we call inflation break-even, which is the expression of the risk or the price for inflation is unattractive, because, as we've seen earlier, inflation is clearly not a threat today, and therefore we do not see any reason for investors to own asset classes that will do well in an inflation period, because we don't see inflation coming back into the system, at least at this point in time. It's also interesting to note that energy, to some extent, even though some of the prices of energy, different values of energy commodities came down substantially, we don't see them as very attractive at this stage, which is quite interesting as well. Maybe the last point is also the fact that, and we had that for many years now, investors have looked at ways to generate income with their investments. And as interest rates here shown in blue, 16% in 82 to almost zero today. All investors, and pensioners in particular, that used to get a nice income from their portfolio now have a portfolio that is yielding very little. And therefore, when you relate the interest rate with what you can earn from an equity market perspective, using here the earnings yield, you see that equity tend to be attractive compared to fixed income. And from our perspective, it will certainly continue to attract investor in the way they shift their allocation to fixed income instruments towards more equity related instrument, including private equity. In a nutshell, or in a summary, the macro environment clearly has improved. The sentiment turned, and we see the valuation of especially growth assets pretty attractive at this stage. And in terms of the impact on the asset allocation, we like equity. We like what we call quality growth equities in particular, that tend to be more resilient to external shocks. And you will find in that, under that kind of name, all the internet related companies pharma and food-related stocks. And we also see some potential in emerging markets as sentiment and valuation are improving. That's it.
Okay, so thank you very much. Thanks, Cyrille, for those very interesting topics and your insights. So, well, that means I have a couple of questions, not too long, but something that we touch upon is obviously this kind of, because what you present is a pretty positive views, right, with respect to the markets. If I understand well, was kind of saying that, okay, they were a shock, but now there is a kind of normalization, even if yesterday was minus 6% on the US market, but is it a blip or is it something? But if we take the more overall picture, there is this kind of difficulty to, and I just want to have your views on, about the kind of disconnect between Main Street and Wall Street, right? That means if you're looking the news on the economy, pretty, it's not all positive, right? So there were OECD report 2 days ago that were basically saying that, look, you need to wait a bit more time. It will be 2022 where we will be back to the previous COVID-19 situation. So this is what we hear on the real economy, and looking the data on the markets, not looking to yesterday, it's a pretty positive environment. So how can we explain, reconciliate those two views?
The financial assets are discounting mechanism, and they look at what will happen going forward, and therefore they do not look at the level of per se. They look at what is the capacity, ability of companies or credit to, I mean, from a credit perspective, how companies are able to pay down their debt, the ability to pay the interest, and from an equity standpoint, their capacity to generate revenues and profit. And even though the environment is challenging and difficult, I mean, some of these businesses will continue to operate. And if they continue to operate, maybe at a lower capacity level or with a lower capacity to generate growth, but they will still be around. And therefore, the question is, what is the price that you as an investor would put on the earnings capability of these companies, or how much do you want to be compensated for the risk of lending money to a company? And if these companies will continue to operate certainly in a very different environment, they will be able to generate revenues and be able to pay down debt. And therefore, all the risk that we are seeing today have already been priced in. And one of the reasons why the market was in a kind of free fall uncertainty was high, and market participants were not able to put any numbers on what could be the consequences of the crisis. And as you start to be able to put in place different scenarios, when you can quantify what would be the impact, then you will be able to price the risk that you're taking in a much more appropriate way. And I think that's exactly what is happening.
Okay, thanks. There is a related question too, which is about, so what you're saying is basically market price are discounting the future cash flows, yes. Right? But there is also we need to think about the kind of distortions that are coming with respect to the market pricing. So, for instance, the Fed now start to talk about cap the interest rates on the medium on the medium duration of the yield curve. Obviously, this will this will have a big impact. The trillions that the Fed is and also the ECB are putting on the market. So will for you the market prices are still a reliable indicator of the economics, given all those potential distortions, right? And because if, for instance, the Fed decided that they will kind of manipulate the yield curve, that means now it won't be reflecting the inflation. And so there is really an impact about what kind of information, in fact, those market prices that you showed to us before are really reflecting inflation, future potential growth, and so forth, if you have such tremendous intervention of the central banks. So what is your view on that? Basically, our financial indicators still reliable?
Well, I think the intervention of central banks aimed to address the liquidity and issues in the first place, and also make sure that capital is available. And it's of course critical in an economy where debt and leverage has increased substantially. The central bank intervention clearly have created distortion, but they also have anchor interest rates at a very low level, which from a company standpoint or from a market standpoint, there is one dimension that you can rely on, is that interest rate will stay low for an extended period of time. And when you are discounting cash flow, if the interest rates or the discount rate is lower, it means that the future cash flow are certainly much more attractive. And I think from a valuation standpoint, it has a very positive impact. First, as it removes the uncertainty of volatility on the interest rate, as they will be kept by central bank at a very low level. And the second is the level, which is key, where companies can borrow with a fairly high certainty that interest rate will continue to stay low and therefore support their activity. And for these reasons, if you have the same cash flow or the same growth in cash flow, that's a big question mark, of course. But if we take the assumption that the cash flow are similar, then these future cash flow are more attractive today, just because the interest rate are lower, and also the fact that the volatility or the risk of seeing them higher is lower as well.
Yeah, correct. Yeah, thank you very much. Well, last question, more on asset allocation. Do you think that there exists an all-weather portfolio that can weather any kind of storm? What are your views on that?
Overall, it's all about diversification. Then the question is more: is the principle of diversification weather this kind of extreme market circumstances? Here I'm referring to the slide 22, where you see two different asset classes. The dark line is the fixed income, the government which tend to measure the performance. You have in light blue the equity market. Here it's MSCI World, and you see what we call the traditional 60-40, which is 60% equity, 40% bonds. And you see that yes, that portfolio went down approximately 10% at the worst time this year, and is barely positive today. And I think it's a very simple, basic diversification by using two asset classes. You have certainly more resilient portfolio that can be built using different asset classes that will weather these kind of storm in a much smoother way than if you have only one asset or one particular investment. I think what generally, as a kind of general statement, this time of unusual market behavior, you tend to have much more correlation or less diversification benefit than you initially thought, because these measures tends to be calculated over the long run in normal circumstances, and clearly the circumstances we went through were not normal, and therefore you should not be surprised to see a behavior that is becoming much more similar across asset classes, and therefore the diversification benefits tend to be lower than in normal time. And there was a lot of question about some of these what we call risk parity construction, because most of them tend to have a fairly high level of leverage built into their construction, and it also force investors to rebalance their portfolio much quicker than the traditional buy and hold portfolios. And the performance of these strategies have been certainly magnified by the amount of leverage and turnover, but some of them have been quite resilient as well. It's more a question of understanding what are the fundamental diversification principle that you have in the portfolio, and the nature of the investment that you have in the portfolio, and not only relying on a single measure, which is in general, in many cases, diversification or lack of correlation.
Okay, so thank you, Cyrille. Thank you for all what you provided to us. Very interesting. I want also to thank all the participants, and I'll see you in the next webinar. We were talking about public market. The next one will be on private markets. Thank you very much, Cyrille.
Thank you. Have a wonderful weekend. Bye-bye.